paper gold market has been consolidating, but the physical market is seeing an uptick in demand. Peter Hugg, a global trading director of Kitco Metals, joins us today. Peter, welcome back.
It's good to be here, David.
So, physical market, let's talk about that offline. You're telling me there's a pickup in demand, and it's a curious thing given where prices are at.
Yeah, I mean, to be honest with you, I'm quite surprised, but retail demand is extremely strong on both gold and silver, especially in the coin market and to some extent in the small bar market. Both the Royal Canadian Mint and the US Mint are on allocation. Premiums are starting to rise, both for the Eagles and the Maple Leafs, both on gold and silver. It's been difficult for dealers to keep inventory on the shelves. And although we don't play this game, it's a little dangerous. There's a multitude of dealers out there when you see their sites that are selling product as far out as 4 weeks from now, in anticipation that they'll be able to receive product to fulfill those orders. Again, I think that's a dangerous game. We tend not to sell inventory unless we have an absolute guarantee that we're going to have it within the next week to 10 days. But it has been something that has surprised me, given the fact that gold and silver have been consolidating and not really moving up through levels, gold 1900 and maintaining, and silver up through $26. I would have thought, if anything, people would have possibly been selling a metal at these levels, but retail demand is extremely strong, and I would anticipate that this will continue for the next month or two, and premiums may be pushed higher as a result of the demand.
When you say that premiums are rising, are they still below COVID levels? Back in March when premiums were, way up high.
They're not that crazy. I mean, Silver Eagles aren't trading at a $15 premium where they were in, late March, April of last year, when this mess first started. But they are moving higher. So to give you an example, Silver Eagles were obtainable in the ballpark of around a $4 premium to spot silver last week. They're closer to $5 now. Gold, silver Maple Leafs were trading in the $3.50 range. They're closer to $4.50, so they've moved up about 20%. On the gold side, gold buffaloes and gold eagles are up probably $10 higher retail premium than they were a week ago. And it's difficult to get anything other than coins. Like 1 ounce bars are tough to get. The premiums on those are holding where they were last week at about 45.50 over gold. But again, with this demand coming in and the mints on allocation, I would suspect that if this demand continues, the premiums will start to move higher as dealers, especially dealers that are selling 2 to 3, 4 weeks out, don't want to get caught with a premium adjustment after they've locked in their pricing. So if you're looking to engage in the retail market, the pricing is still relatively inexpensive, but that pricing could move higher again based on current demand we're seeing.
What are the products that are going up or going out the fastest?
Well, the primary products in the U.S. market are obviously gold eagles, silver eagles, buffaloes. There is demand for gold maples. Gold maples, because they're 4.9s gold, compete with the buffalo, but have much more of a demand factor from an international perspective. So gold maples are tough to keep on the shelf. Fractionals are almost non-existent. The mints are putting out fractionals in very, very small quantities. Whenever they come up on sites, they're gone same day. Silver 10 ounce bars are very difficult to get. So again, when they come up on the stores, they go fairly quickly. The only silver product that still has a relatively ready supply are 100 ounce RCM bars. But again, if the demand continues and the coin market starts to dry up, the 100 ounce silver bars are going to be gone. People will just shift to the larger product, and you'll start seeing premiums and supply issues with that product as well.
Do you think it's possible that retail investors are anticipating maybe an uptick in gold prices, which is why they're buying a bunch of physical right now?
Well, I mean, retail's trying to allocate their money. They're worried. You've got, Biden's proposal of 1.9 trillion. I mean, just the increase in the budget deficit and what that probably is going to do to the dollar throughout 2021 would indicate to me that the macro picture is still bullish for the metals. And retail investors, the smaller retail investors aren't chasing the equity market right now. They want to deploy their capital somewhere. They think gold, at the sort of 1850 level and silver in the mid 20s is a good medium to longer term investment. And they're deploying their assets. And they're buying physical. They're not buying ETFs or funds. They're buying physical. And again, I'm surprised, but I thought at these levels that the demand would just sort of wane off because the market has been kind of quiet in a tight range, and that generally fades the interest in the retail market. But retail demand has been much surprising. The strength of retail demand has certainly surprised me in January.
It's an interesting point you brought up, Peter, the ETF flow. So I'm looking at data from the World Gold Council right now. And if you look at this chart, the last 2 months of recorded data, November and December, both showed negative outflows, which means that there was more outflows and inflows. Now, is this an indicator to you of weak investment demand going into the new year?
No, I mean, I think people took some money off the table coming into the end of the year last year, took their profits. A lot of the bigger players are involved in the ETFs, and they may have rotated into equities. They may have even rotated into Bitcoin. A lot of these bigger dealers also have crypto desks. So I'm not too concerned about that. I'd sort of want to monitor it first quarter of this year. But ETF holdings are pretty much almost at record highs. With the gold market sort of pausing in the fourth quarter of 2020, it would make sense that you would see outflows as people started to take their profits. I mean, there's a lot of big players in this market. To give you an example, on Sunday night, this past Sunday, when the Asian market opened, I mean, gold dropped almost $40, and they called it a flash crash. It's once gold got through about the 1825 level, it just crashed right down to 1800. Again, if the guy was trading for me, he wouldn't be working for me anymore. But anybody selling volume into an Australian Open is out of their mind because there's no liquidity in that market. But it held right at 1800, and there was aggressive bidding, and it didn't take more than an hour and a half to bring it back up over 1825. So there are people out there waiting for pullbacks here to add, and they're significant players. So I consider the overall macro picture still bullish, and I'm impressed, and I think gold will close above the 1850 level again today. I know it's frustrating for investors. They're all waiting for that, $2,000, $3,000 number. But this is a relatively healthy metals market. It's consolidating, and given the macro picture and the continued stimulus and central bank liquidity that's in this market, it's difficult not to be bullish this market for in 2021.
Let's talk about inflation now. We were having a chat offline about this. So 900,000 jobless claims last week was the latest reading for the unemployment front. I wonder if this has any negative weight to inflation expectations.
Well, again, if you remember our conversations that we've had over the past few sessions, I think inflation is going to be an issue, but I do not think it's going to be an issue until this economy starts to resemble more a full bore economy. And I'm optimistic with the vaccines that are in the market. Not impressed with the efficiency of the distribution, but we are getting it done, albeit not as efficiently as you would have hoped. And if it continues, and if Biden's plan on putting 1 million vaccines in arms a day becomes a reality, I'm thinking that we could get to a level of, again, I'm not a doctor, but using the jargon in the market of herd immunity sometime mid to late summer. And if that's the case, I would expect the fall to be looking much more normal. Again, I'm hoping and praying. And in that context, I think at those levels, we would then start to see a more robust pickup of inflationary trends.
And you said towards the summer, is that right?
Again, it's my precondition on inflation is going to be when is this economy going to look somewhat normal, and it certainly isn't normal now. I mean, I still think 30-40% of the economy is locked down. I mean, the airline industry is a mess. Any of the leisure industry is a mess. The hotel industry is a mess. Restaurants, for the most part, are an absolute shambles right now. We need to get people comfortable to go back out and to spend money and to go back to work. And I think that's going to take the vaccine to get us to a level where people have that comfort level. And, just based on the amount of vaccine coming to the market and the time it's going to take to get 2 shots, I mean, if you extrapolate that out, you'd suspect that everything perfectly working would be sometime midsummer, late summer, before we get to the 75-80% vaccinations required in the U.S. To create herd immunity and create normality in the economy.
I wonder if that's what we need for gold prices to eventually break out of its current consolidating range, is a pickup in inflation, a pickup in economic activity, return to normal.
Well, I'm not sure what you're looking for. Gold was at, $1,300 at, a year ago, and it's, still trading at $1,850. I mean, if you're looking for the $4,000, $5,000 number, this is going to happen for one of 3 reasons. One, there is going to be a significant geopolitical event, whatever, a war with Iran or a war with North Korea. Again, that probably would be a temporary situation, but I think those are the types of geopolitical issues that could create a move on gold of significant proportion in the short term. If inflation comes back with a vengeance, and again, it'll be a stepped up approach. You're not just going to wake up one morning and inflation's going to be at 8% from where it is right now, roughly at 2%. It'll be a stepped up approach. Then it'll be, how will the central banks react to inflation moving higher? My best guess is that they're going to be behind the curve, and we may see something similar like the late 70s. In that context, we have another significant catalyst to run gold prices higher. If you're looking for the third scenario, would be what a lot of sort of investors have been told since gold freely started trading in the 70s, is that the whole economy is going to implode and fiat currency is going to be worthless. In that scenario, yes, you'll get a reaction up in gold. I don't think it'll last. But so those are the 3 scenarios. The last scenario was one that I am not hoping for, because I don't want to live in that world where everything implodes because I have a few ounces of gold. To me, it makes absolutely no sense, because everything else would be wiped out as we know it.
I think we talked about this briefly last time, and I think the key here is the time frame, right? Because these are scenarios that are needed for gold to move up quickly in the short to medium term. We're not talking about, $4,000 to $5,000 in 20 years. We're talking about, let's say, in 2-3 years, what would need to happen for gold to reach that price in 2 years, right? Or 5 years, whatever the case may be, but not in 20 or 30 years, because the argument, the counter argument here is that gold can naturally double or maybe even triple in price from current levels in, 20 years from now.
Geez, I hate to be a sort of a wet blanket here, but so let's go through the scenario of inflation. We get inflation coming back, and the central banks are behind the curve. You're going to have gold running up, so maybe it runs to $2,500, $3,000 an ounce. But in normal cycles, when that happens, assuming we will have normality somewhere down the road, what happens in that scenario is that usually the central banks step in and then they start to tighten and they make money expensive. And as money becomes more expensive, less money is created, and also it is less. Consumers are less inclined to chase goods when their cost of capital is much higher. So what happens is the economy slows down, and what does that do to hard commodities? It creates pressure on the commodities, and the cycle starts. And then we're going to go into a bear market in gold. Now, I don't think the bear market in gold that will come, whether it starts in 22 or in 23, is going to bring gold down to $800 an ounce or $1,200. I think every time there's subsequent bear markets in gold, the low is going to be higher than the subsequent bear market. And then the next time you get the cycle going back up and the commodity cycle is bullish, gold will surpass the previous peak. And that's just the way the market trades. If you're looking for a market that's going to go up and never come back down, and just eventually in 3-4 years from now be at $5,000 or $8,000 an ounce, I just don't think that is likely unless the central banks just allow hyperinflation. Now, it's possible, probably not likely.
Well, Peter, thanks again for your update this week, and I look forward to speaking with you again next week.
It was a pleasure. Thanks, David.
Thank you. Thank you for watching Kitco News. Stay tuned for more.